Good afternoon, everyone, and welcome to the BMO Auto Finance Retooling Your After Sales Approach event. My name is Andre Salvi, and I'm Senior Vice President and Head of BMO Automotive Finance. It's my pleasure to welcome you today to what we hope is a very informative and engaging event. I'm joined today by Eric Johnson, BMO Economist, and Eric will walk us through the current economic conditions that face the auto industry today and give us a look ahead of what we can expect for 2023. We're also thrilled to have Wolfgang Kohler and Andy Campbell, who are after sales consultants from Firing on All Cylinders Automotive Consulting. They will join us in the second half of this session and present some thought provoking questions and perspectives surrounding after sales and service. Before we begin, we're going to cover off some quick housekeeping notes. Thank you for submitting your questions in advance through registration. We've worked these into the Q&A later on in the event. Feel free to submit a question for any of our speakers through the chat feature you will see to the right of the video, and we'll try and work those into our Q&A portion after the speakers as well. In addition, we'd like your feedback on this event. You'll find the link to a short survey below the video. Your participation is anonymous and will help us shape future events. When we wrap up the event, we kindly ask that you take a few moments to complete the survey. All right, let's get started. Over to you, Eric.
Thank you so much, Andre, and good afternoon, everyone, or good morning if you're joining us from the West Coast. And so I'm going to walk through, some of the implications we're seeing in the auto sector today, and in the broader kind of macroeconomy in Canada, United States. Given this very aggressive interest rate hiking cycle we're seeing, in addition to quite turbulent energy and commodity markets, as well as certainly decades high inflation as well. So I think where I wanted to start was a little bit with where we're seeing kind of, the auto volumes or the light vehicle sales market go in particular. So I think, if we, zoom in a little bit and think about, just volumes for a minute here, if we look back over the past kind of 3 years or so, certainly you'd come to the conclusion that, the auto sector wasn't looking very healthy, just from a pure volumes point of view. In many ways, volumes have been kind of stuck almost at recessionary levels for, quite some time. And that, there was a myriad of factors that featured in there, whether it was, initially kind of COVID in 2020 and, some of the kind of supply chain implications of that. And then certainly in 2021, what we had is the semiconductor crunch, really start to, certainly play a dramatic role in limiting the available vehicle supply. And so that's ultimately, kind of what we're seeing on, the history of where vehicle sales have been. Now, I think one thing I'm, going to attempt to say here is, the four most dangerous words an economist can say, that, but potentially this time is going to be different. In that, normally when the global economy is slowing down, the auto sector is always the industry that's at the top of everyone's minds. That's really going to feel the full brunt of that slowdown. But I think as a result of, demand just being so much above where supply has been able to be over the past kind of, few years now in the auto sector, we're pretty optimistic anyway that at least 2023, certainly won't be back to normal if we're thinking normal is sort of pre-COVID volumes, but certainly it's going to likely be better than we saw this past year in 2022. And then looking ahead to 2024 as well, we're optimistic that the market can kind of hit back to volumes that look a little bit more like those kind of pre-pandemic levels. Now, again, when you're thinking of why we're a little bit more bullish on kind of the Canadian outlook there than the US is, the three factors there are predominantly thinking about kind of where population growth has been in Canada. Population growth in Canada is, kind of one of the ace in the holes, and certainly G7 leading if we compare it to the United States, where population growth has been very meager, for the last several years, really since kind of 2015, 2016. And then the second piece of it, we saw a little bit less, kind of vehicle priority or model priority in the pandemic to Canada relative to the United States. So that's another thing that kind of benefits the, comeback in Canadian vehicle sales. And the second thing is, a ongoing factor in the North American market, which is from a saturation point of view. The Canadian market is still, fairly behind where the US market is today. So again, back to this point about demand versus supply. So if we were talking about broader, indicators of kind of macroeconomic kind of production or, industrial production, they would look a lot different than where we're kind of seeing North American or even global, auto production over the last few years. So if we're thinking of in a Canadian industrial production sense or a US industrial production sense, both of those are already above kind of pre-COVID levels. Whereas if we're thinking of where auto production is, even through October, we're still down roughly, kind of 11% year to date compared to 2019. And so that's giving you a sense of just how big of a hole, we still have to make up for for, just to get back to, kind of where production levels were. But then when you add on the fact that, there's a fair bit of pent up demand up there, production still has a long ways to go to kind of meet those needs where, it's kind of supply and demand are in a little bit better balance there. So I think that just gives you a sense of, relative to a lot of other sectors that have also gone through supply chain woes, the auto sector is certainly at the very top of those lists that is, certainly feel the worst effects of all of those things combined. And so again, if we're thinking of demand, one of the best ways to summarize that is kind of in this slide where we're thinking about, if we take the kind of pre-COVID trend for both, kind of Canadian and US auto sales leading into the pandemic here, and then trace out where actual auto sales have been, I think what we're seeing here is, this is to a degree of how much kind of pent up demand is out there relative to what we kind of would have seen in more normal times. Obviously, that's a big if in indicating, it would be, without a pandemic and without sort of the supply crunch that we did end up seeing. And there are a few caveats that I think you want to walk through any kind of calculation like this. So the first you want to be careful with here is obviously during the kind of height of the pandemic itself, a lot of those fleet sales are probably never coming back, right? A lot of rental car fleets, weren't really participating in the market for obvious reasons, and they're, unlikely to really, kind of come back and make up for lost time, so to speak, from a sales point of view. And all you have to do if anyone has taken out a rental car in the past, few years or so, you might have noticed the odometer doesn't look anything close to what you might have been used to, thinking about what a used or a rental car odometer looked in the past. So I think that goes to speak why we're unlikely to see that come back. So it's important to kind of deduct those. And the second piece of it, obviously, we've seen immense interest rate hikes, and those certainly feature in any kind of, bigger purchase durable good, with autos being, kind of near the top of the list behind housing there. And so if you factor in those two things combined, we're looking still at, around 600,000 units of pent up demand in Canada and around 2.5 million, and again, would be through November, of pent up demand in the United States. So certainly, we're talking in the millions of units here across kind of the Canadian US market. And again, from the relative point of view, in Canada, that's typically around, 5-ish months of, typical sale unadjusted sales. In the US, it's, just over 2 or so. And so again, I think it speaks to, not only does, kind of supply have to bounce back, more than normal, but for it to kind of, increase enough to make up that gap is one of the reasons why you're likely to see kind of, the sector kind of continue to do well from a margin point of view. And the second piece of that story certainly is the idea of why we're, not really seeing kind of any incentive growth relative to, what we might have been used to kind of in typical pre-pandemic times. And that's just, demand is still well in excess of supply. And that's, kind of the big continuing driving force behind the sector. So again, I think that speaks to, whether we're likely to see inventories kind of come back to anything that we saw, pre-pandemic. So I think we've seen some really good news on this front in the past several months. US inventories, perked above 1.5 million units, which again is, an absolute immense increase since, the kind of trough last year where they were, well below a million units. The challenge there is that, if you think back to the pre-pandemic times, that number was, well in the 3.5 million range. And so I think, it's a question here of where, competition versus, I guess the appetite for the new queuing model kind of, goes in the next several years. So, personally, I think kind of that queuing model is here to stay for a little bit. In that, certainly the automakers really like the idea that, you have a pretty consistent idea of how much demand is coming in the pipeline, and it gives you a lot more, ability to kind of price the way that you want to, relative to the view that, when you obviously have lots of vehicles on the lots, you have to move those a lot more quickly to kind of bring in more supply. So, I think if time gets tough, we could see kind of that competition aspect perk up. But I think for a while we'll be stuck a little bit more in this kind of queuing model, and electric vehicles are only like to kind of increase that trend towards queuing versus, kind of the surplus model of inventory. So again, I think, this is showing up predominantly in prices, right? So, prices are obviously going up all across the economy, but certainly if you're paying attention to auto prices in North America, and these are in particular looking at kind of US used and new vehicle prices, but, this is broadly a story of, what these shocks have done to the market. So obviously all that supply pressure on new vehicles has really pushed up, kind of consumer prices for new vehicles in the United States and certainly in Canada as well. And that's been a really important driver of success in the industry in terms of a margin point of view. Now, I think when we think of used prices, right, used prices went up even more dramatically than new vehicles for, a lot of the same reasons. So one, you had kind of a big affordability and price shock hitting, the new market at the same time as hitting the used market. But, used vehicles typically anyway were a little bit more affordable. And so that pushed a little bit of demand, particularly on the lower kind of credit score, lower income side of the market into the used vehicle space at the same time that you had these dramatic shocks on supply in used vehicles, right? Fleets weren't buying new vehicles, which meant they weren't recycling that into demand. And then at the same time, people couldn't buy new vehicles, which meant they also weren't, kind of returning their old models as a, additional source of kind of used vehicles. So again, I think we're well into a correction on the used vehicle market. So again, if you were a dealer that was making tons of your kind of bottom line on the used vehicle market, yeah, you should be a lot more concerned about what 2023 and 2024 will look like from that point of view. Wholesale prices in the US are already down about 14% year over year in November. And so that is giving you an indication of where retail prices are likely headed. And I'll get into a little bit of the factors that are driving the used market. But again, I think it's something that is certainly quickly turning around in comparison to the used market. And again, another way of summarizing this is when we think of kind of this Cox Automotive survey from kind of franchise dealers in the U.S. of where they kind of see these two big factors going. So one of them being profits, the other one being inventory, right? Profits certainly are very elevated relative to normal. They've started to correct, but again, I think it's going to take some time for those things to come anywhere back to kind of those pre-pandemic levels. And on the same side, inventories are recovering, but they're recovering very slowly. And you didn't have to spend too much time looking at those kind of production graphs to see why it's taking so long and just how big that hole is to make up. So again, I think one way of summarizing why margins have gone up so much. So this is showing kind of the difference between where producer prices for kind of new vehicles have gone versus consumer prices in both Canada and the United States. And so again, I think certainly both have gone up, and I think it's important to note that. But just because of how much pent up demand and kind of how strong consumer balance sheets were through the pandemic, that's one of the reasons why we saw so much of an acceleration of consumer prices. And one of the big components that factor into producer prices certainly is on the labor side. And just from the nature of how the industry is structured, you tend to get a little bit more lagged and delayed kind of reactions to where kind of inflation goes. So I think you'll see some catch up there. But again, I think this is one of the reasons why margins were certainly so healthy and strong over kind of the past year and a half, and certainly is a big driver of why there was so much M&A activity in the sector, right? Because a lot of people, if they were already wanted to sell, say, a rooftop prior to the pandemic, they were probably very interested in using their valuations in 2021 to drive any kind of sale like that. And so I think this is just speaking to why it's going to take a long time for those margins to correct. Is that's quite a big gap to kind of make up, and typically those things really move in sync with one another. And so I think that's a big story that we're kind of left with because of this, certainly pent up demand and a little bit of obviously an absolute, dearth of supply in the market. So again, one reason when we're thinking about where supply is going comes down to obviously where kind of semiconductors, availability is going to be and where it has kind of gone over the pandemic. And so I think one thing that's certainly a good news story from the auto industry point of view is, the auto industry is typically around 10% of the global market for semiconductors. I think the good news there is that a lot of that kind of demand over the pandemic that was driven by, kind of high-end electronics, so think your smartphone and things like that, that's really started to cool off kind of in the latter part of 2022. So I think that is certainly a good news story for the auto sector because they basically at this point want to buy every single semiconductor they can get their hands on. The second kind of challenge here is that certainly the industry has, kind of increased kind of production capacity as you see, kind of on the second graph there. The challenge is, the auto sector is a little bit of a legacy purchaser of semiconductors. So, a leading edge semiconductor today is typically kind of from a node size or like the width of kind of the silicon chips that they build them on is 3 to 4 nanometers, and so that's what is going into the latest electronics you're buying, and that's the thing that produces the highest margin for chip makers, and so that's the thing they're gonna want to make more of. Automakers typically are buying chips that are wider than kind of 34 nanometers, and so again, that's the kind of production capacity that hasn't come up as much, and it's one of the reasons why you kind of have this not only mismatch between kind of demand and supply, but also in particular for the auto sector, they've been a less attractive customer kind of over the last 2 years, but I think that's changing, right? So you're finally going to have these natural partners between chip makers and the auto sector where a big section of their demand is kind of going to fall over the near term, and the auto industry is certainly going to want to buy more of them. And the second piece of it is, as they kind of shift the production model a little bit more towards kind of electronic vehicles, that's a another thing that's going to kind of bias their, I guess, distribution of purchases a little bit more to modern chips. And so again, I think it's certainly something that's going to help the sector, but it does speak to why it's taken so long for this issue to be resolved, is because it wasn't just a demand story, but also kind of supply wasn't really even kind of benefiting the sector to a degree as much as it could have if they were on kind of the leading edge product already. So again, I think when we're thinking about what's going on with the newer used market, so I think the used market is really in the midst of, the peak of its affordability shock, right? So pre-pandemic, the term structures on new and used vehicle cars looked very different from, how long the loans were structured. But I think what we saw, just as, new vehicles certainly were hard to purchase and, the price points were getting prohibitively high, the used market really took off. And the way that you kind of, increased affordability, no different than if you were on a variable rate mortgage to kind of lower your stress test hit in the Canadian housing market to a degree. The same thing happened here, right? You can increase the term, lower your payment. But the challenge is we kind of reached the maximum threshold of that. And that's one of the reasons why demand is really starting to kind of take a hit in the used market. And, there's not much more space you can go here unless you want to have, a bunch of used term loans that basically are all at, negative equity by, the latter part of their contracts. And so I think that's the real struggle in the market. And until rates really come down, you're not going to see much change in that kind of affordability piece of the story. Obviously, prices are coming down, and that will help. But I think that's the fundamental force that's kind of driving that market here. Whereas used vehicles haven't changed much in kind of lending structure, and a lot of that just has to do with on average is a lot higher credit score and income customer that's participating in the market today. Not unlike kind of what's happening in housing markets kind of in the West as well. With kind of prices and kind of rates both putting affordability, in very challenging conditions for the average or the median household. So again, I think the two kind of big shocks that are also hitting kind of consumers in certainly Canada and as well in the United States at the same time is, they had this huge appreciation from a wealth point of view if they were homeowners, and now we're very much in the midst of that kind of correction. In Canada and certainly as well in the United States. And so right now, overall prices are down about 10% from kind of their February peak in Canada overall. And again, sales are likely to stay pretty low for much of the kind of remaining couple years here. And so I think what you're seeing is if you were a household that was thinking from a wealth point of view, I'm feeling pretty comfortable, this is one of the things that you're absorbing and is certainly kind of featuring into where we think of people's consumer confidence. And one of the reasons, yeah, you might be worried about where their ability to kind of fund an auto purchase would go, because this is certainly something that's going to weigh on them pretty heavily. And I think another thing to think about is if we look at past kind of housing market corrections, these are things that move very slow. We right now have a situation in the market where buyers don't really feel pressured to buy because they still think prices are high, they're likely to come down, and sellers, particularly if they bought a little bit closer to the peak, are also in a situation where they aren't really very comfortable selling, right? They still want something close to that high point of the price, and it's going to take a long time for the psychology to kind of turn over there and be a little bit more willing to kind of change their view on things. And the biggest mover of where this market goes is how high kind of mortgage rates go, and how long they sustain at those high levels, because that's the ultimate determiner of where kind of purchasability and price points go. Because right now affordability is an absolute dire challenge in the market, where you haven't seen affordability challenges this big, certainly in the Canadian context, since the late 80s. um, in the height of in the lead up to kind of the one of the last kind of big real estate corrections, certainly in Ontario. And so again, I think that's the piece of the puzzle that's making this challenging, and certainly is weighing on kind of consumer confidence in the U.S. So the second kind of well shock that a lot of people are facing is coming from financial markets. And I like to call this is there's really been nowhere good to hide, so to speak. Whether you were kind of a traditional maybe 60-40 split equity fixed income investor, right? At different points of this year, you were potentially down 15% year to date. And I think some of those equity markets are certainly rallying a little bit more as we come into the close of the year. But I think this is the other piece that households are trying to absorb when they're thinking about kind of making longer term purchases, right? Is that not only is their housing equity position and where their mortgage payment might be going not looking as healthy as it once was, but this is the other thing they're thinking about when they're looking at their retirement statement. And so again, I think that's one thing that's also weighing on where the auto market and the durable markets in general are headed in the year and next couple of years ahead. So again, when it comes to what that means for our outlook, so again, the growth party is a little bit over, so to speak, at least in Canada, the United States. So the rebound certainly created well above trend real GDP growth in both Canada and the United States. So Canada favored a little bit better this year just because we opened later than the United States, and a little bit from historical accident, right? When you had kind of Russia invading Ukraine, Canada happens to produce a lot of the same commodities that Russia and Ukraine do as well, and so a lot of producers certainly benefited from that commodity price shock kind of at the start of the year as well. As we head, kind of into 2023, we're very much in the camp that is calling for kind of a mild recession, and certainly emphasis on mild there. That overall, kind of growth will be flat in 2023. And I think what we have seen so far is there's been a lot of resilience, certainly in consumer spending in Canada, the United States, through the third quarter. And so maybe we certainly could be wrong about the timing, but we're still fairly confident that at some point in 2023, we will see potentially at least 2 quarters of kind of negative growth or stalling growth, certainly. And so that's like kind of the risk that's weighing on the auto sector as well as the broader economy here, is that we're going from a situation where growth was very much above trend to a situation where we're going to be certainly below trend, in 2023 and 2024 as well, potentially. So again, when it comes to kind of the labor market, the unfortunate piece of trying to control inflation here is that as demand slows down, that potentially is going to produce a little bit more slack in the labor market. And again, I think unemployment rates we have kind of going up in both Canada and the United States, but I think they're going up to a degree that's a little bit less impactful from a delinquency side. So typically, where you start to see really big rises in delinquency in the Canadian market is when unemployment rates really go kind of north of the 7-8% or like into 7 and 8% range, whereas we're still in the mid sixes through the end of 2023 in Canada, and similarly around 5 percentage points in the United States. So certainly more slack, and I think controlling inflation certainly does have its macroeconomic costs, and these are the unfortunate ones. But that's sort of the situation we're in now with both kind of central banks and really central banks globally, kind of being behind the curve and having to catch up, and not really having any divine coincidence, so to speak, of being able to achieve kind of both their mandates or both objectives of maximum employment and controlling inflation at the same time. So again, inflation is really the big driver of where rates have gone and where they're likely to go. And I think what we saw for most of the start of this, inflation surge was it was good prices that were really driving the surge, and services were sort of playing second fiddle. And now it's really flipped. And the reason it's flipped is that kind of you can only keep buying goods well above trend for so long, and that's starting to pivot as a lot of these in-person services are reopening in both countries. But the challenge is, with wage growth kind of running as high as it is in both countries, that's really going to put some stickiness into inflation in our view, in that when you think of service production, right, labor is the really important element there. And so the longer that wage growth kind of remains well above kind of typical trend that would be consistent with kind of target inflation, that's certainly something that's going to weigh on where things go. um, and so again, as we think of what this means kind of in our rate forecast, so we certainly saw the Bank of Canada at least stick to the script that we had, which was hiking interest rates by 50 basis points today. Now, we still think that means they're probably going to have one more potential hike in the start of 2022 to bring the terminal rate to 4.5%. And then the other piece of it here would be in the U.S. We're currently expecting the Fed to hike 50 basis points next week later in December, and then follow that up with 2 additional hikes, again largely because they have a little bit more of challenging of an inflation problem, and so their terminal rate would be in that 475 to 500 or 5% range in terms of where the federal funds rate would go. So I think when you want to think of whether Canada will stop or not, largely is going to depend on where some of those inflation metrics go, as well as how sturdy kind of some of the real economy pieces like the labor market and GDP kind of finished this year. So I think those are the kind of the data dependent things that are going to feature into that decision there. And so the last piece I just wanted to finish on here, when we're thinking about where maybe the risks versus the benefits, or the kind of tailwinds for the Canadian economy go, is really the one thing we are still seeing is accumulated and pent up savings are really strong in Canada, and they haven't even corrected below kind of their pre-pandemic levels. And so this is really the ammunition that can power consumer spending growth in Canada for longer than we would anticipate, with growth slowing down. Now, it also can make the inflation challenge even more challenging, because consumers can still spend money even though rates are elevated. The second piece of it, though, is that with rates being as elevated they are, Canadians really levered up. From a household point of view over the last 2 decades, whereas the U.S. kind of had this forced deleveraging cycle. And so, on the U.S. side, the average household actually does have some space to pick up some of that slack. So I think that's the relative kind of risk benefits of both countries. So with that, I'll turn it back to Andre here, and thank you for listening to my update here.
Thanks, Eric. A lot of interesting and valuable information in your presentation, and I'm sure we'll have some interesting questions after our next speakers. Before I turn it over to our next speakers, let me ask you this. When you think about rising costs of borrowing and just generally broad rising costs faced by most folks these days, everyone's thinking about trade-offs. And as consumers grapple with these trade-offs, where do you see that impacting the new and used car market? Do you see more consumers trending toward newer vehicles because there's perhaps more certainty around the near-term expenses? Or do you envision the mix to stay pretty much the same going out over the next couple of quarters?
Yeah, so I think the mix obviously got very biased towards used vehicles in the pandemic, just from a supply availability point of view in the new market. And I think the challenge for the used vehicle market going forward, right, is from an expectation point of view for consumers is, as you see used prices correcting so much, it does create this incentive to maybe want to wait a little bit to go out and buy a used vehicle. And at the same time, if you were really tempted on buying a newer vehicle today, the availability of getting that is slowly improving. And so I think that is certainly going to force people a little bit more to maybe back to the new market. And the second piece of it here you want to think of is, in addition to just the retail customers, I think for a long time you've essentially had fleets, rental companies in particular, but also, the leasing side of the market as well. They've really been shut out of kind of the new vehicle market for quite some time. And what we're starting to see is those segments are heating up a fair bit. And so I think even as maybe the retail side of the new market might kind of slow a little bit under the weight of higher interest rates and elevated inflation, I think those pieces of the markets can sort of pick up the slack a little bit. And so that's one of the reasons why you potentially see a little bit more of a mix back towards new vehicles from what we've seen kind of over the past year and a half or so.
All right. Well, thanks very much, Eric. Appreciate the perspectives, and I'm sure we'll have more Q&A in a bit. While we're on the topic of new and used cars, we're going to shift our focus now and have our next guest talk more about service bay optimization, the after-sales model, and how that can benefit everyone involved. I'm pleased to introduce Andy and Wolfgang as our next guests. I'll let you both share your backgrounds in more detail, but wanted to start by thanking you both for being here today with us and sharing your expertise. Andy and Wolfgang, over to you.
Thanks so much, Andre. Andy and I are really happy to be part of this presentation today, and thank you to BMO for inviting us. I'll tell you a little bit about myself. And so I've been in the car business for about 40 years now. It's been a long lot of experience. I started my career actually in Canadian Tire, working part-time in high school in the parts department and at a Canadian Tire store. I made that transition into a dealership at a BMW Volvo dealership, and that's where Andy and I met. I worked for BMW for many years and then moved on to Mitsubishi. And I worked for Mercedes-Benz in Kitchener-Waterloo as the fixed ops manager for about 13 years. And from there, I was lucky enough to be invited to be part of the dealer. My dealer principal was invited to build a dealership in Switzerland, and I was lucky enough to be part of that team. So when I was, that was a 3-year project. And when I was done that project, I came back to Canada, and Andy and I started our business together.
Thanks very much, BMO, for having us on here. This is fantastic. My name is Andy Campbell. I've been doing this for over 34 years. Started off in fixed ops, went to sales, general management, and eventually ownership at a Volkswagen store. At the Volkswagen store, we had 10 good years of winning Wolfsburg Crest, 10 years in a row, and also a gold pin, which I'm very proud of. And I believe those awards were because we built our processes on how we did business through our customers' eyes, but we let our employees build the processes. We'll get into that a little bit more as we go on here.
All right. I wanted to really start to think about our after sales business and what it's like at your dealership. What's it like in your world? And so I have some thought starters that I want to really talk a little bit about. So one of the main KPIs that Andy and I believe is one of the most important, if not, or at least one of the most important ones, is productivity. So Annie's going to talk about productivity, but what is productivity? And what is your workshop's productivity? And does your service, more importantly, does your service manager know what it is? And does your service manager know how to calculate it and how to improve it? And what is efficiency? And what is your shop's efficiency? And who's responsible for it? How do you rank nationally on CSI? What is your appointment and scheduling plan? Do you book for the amount of hours, or do you book the amount of appointments? Do you perform service walkarounds? Are you optimizing your alignment rack? Does it get used? Is it just a place to store things? How much is your parts inventory? What's it worth? What's your day's supply? What's your OBSO position? What's your manufacturer parts fill rate? How often do you receive a stock order? Is your detail business an expense or a profit center? And are you really in the tire business?
So those are all great questions and things we work on with managers, but we have a belief that every day our technicians walk through the back door and they hand us a gift. And the gift they hand us every day is a gift of time. So when we talk about productivity, I've just got an hourglass here. And when we look at productivity, and let's say the dealership's productivity is 80%, we look at this whole as 8 hours. And we have 80% of their time that we utilized and 20% of their time that we didn't utilize. So we're going to concentrate a lot on this 20% we didn't utilize and why. How come we didn't utilize this time? Just go back to the slides if we could. We were recently at a dealer and we thought we would use this as an example for today of what productivity meant in both lost hours and lost dollars. So I'll run through the math. And this dealer, This dealer had 7 technicians, so a smaller size store. The gift, that technician walked through that back door with a gift of time. They gave 8 hours of time. And don't forget that we've paid to train that 8 hours of time. It's skilled labor. This dealership had a productivity of 72%. Now, 72% doesn't sound bad. You know, it's a passing grade for me for sure in high school. My father would have been happy with that, but 72%, what does that mean to us in productivity? So each day that technician comes in and they give us 8 hours of time. They run at a productivity of 72%. So therefore, they're punched on cars, working on cars for 5.76 hours per day. What does that mean in lost hours? So the gift was 8. Our service department managed to utilize 5.76 hours of this time. So I had a loss of 2.24 hours per day. So if I look at this lost per day of 2.24 and I multiply it by my 7 technicians, I come up with lost hours of 15.68. Now, a couple of things I want to say about the 15.68. It's interesting. We all are on the hunt for technicians. They are, we are looking for them, grooming them, finding them any way we can. But 15.6 hours to me kind of indicated that's 2 extra technicians I had within my own 4 walls. I just had to utilize their time better. But if I look at it by money, I've got 15.68 hours. I've got a door rate at this particular dealer was $139 an hour. We had lost sales of $2,179. Okay. I take that, I might multiply it by 21 working days in a month times the 12 months. I've got a loss of $500,000. Okay. And we all look at that and go, wow, that's a lot of money. It gets worse though, because in the after sales world, there's something called parts to labor ratio. So this dealership had lost sales of $549,000. They had a parts to labor ratio of 1.1. So when we look at lost sales, multiply it by the parts to labor ratio, we have lost part sales of $604,000. Okay. We've got a loss of $1,153,000. Now, you're never going to get to 100% productivity, and we know that. You're not going to get there. But the interesting thing is when we sat down, talked to the dealer, and we said, well, what happens if you go from 72% to 82%? If we can just get that 10% growth in productivity, what would it generate? Well, it would generate $411,000 more in sales. And if we could take it from 72%, 15% to 87%, we're now generating $617,000 in sales. Numbers they're staggering when you look at this lost time. And especially when we go back and look at how much we're looking for technicians, sometimes these technicians are already within our own service departments. We're just not maximizing the gift our technicians give us every day.
Now, if you think about this in an interesting way, but if you look at if a parts manager lost $1,000 part in our parts department, we would all know about it. Everybody would be involved in looking for this part, finding out what happened, looking at receipts. But a service manager loses more than that in a day and nobody says a word. So how do we lose it? Where does it go? And here's just some ideas on where to look at. Bad service appointments. We believe you can lose the service game right away before the game even starts being played, and that's by appointments. Can think about this example, what time do your technicians start? They start at 8 a.m. in the morning, and your service advisors start at 8 a.m. in the morning. How long does it take for that first repair order to make it to the workshop? Does the technician stand around for 15 minutes, for 20 minutes? How long? Incorrect punching. Do your techs know how important punching is? Punching properly not only helps us get the right amount to be billed, for example, to warranty or to the customer, but it's also important for us to get that data into our DMS system. And with our DMS system, we can utilize that better to book proper appointments and utilize the workshop and increase our productivity. Being prepared for the customer. We want to make sure that we know when the customer's coming in that we'll have the proper parts in stock. Do we have the right technician to work on the car? Do we have the special tools? We don't want to waste anyone's time. We don't want to bring a customer in who booked an appointment for brake rotors and pads and then find out we don't have the rotors in stock. And are you performing walkarounds? It's a fact that a lot of customers who are performing walkarounds with their service advisor start to remember things during that walkaround that they forgot to mention during the appointment. And this adds more lines to the work order and keeps our technicians busy. Selling oil changes and not services. This is a big thing that we find when we're out on the road visiting dealers, that service advisors sell a lot of oil changes because the customer has asked for that. But are they selling the value of a service? Are they selling the value of doing that recommended manufacturer service? Are we pre-picking parts for our technicians? And better yet, are we delivering the parts to our technicians in their work bays so they don't have to leave their work bay to come to the parts department? We all know that technicians, if you have 10 technicians standing around the parts counter, that they're going to waste time talking about yesterday's hockey game. Denied work. Are we tracking our denied work? Are we getting the denied work in our DMS system? But more importantly, what are we doing with it? Are we making those phone calls when we're slow in January or February and get more work in the shop when our productivity really drops? Do your technicians have goals? Does the service advisor have goals? What's expected from our staff? What are we trying to achieve? Do they know that? Do we communicate that? And is work going to the right technician? So when Andy and I start working with a new dealer, we start online and we work with about 8 sessions and we start working on teaching them the KPIs. And we don't have a lot of KPIs. We have a few KPIs, that probably 15 to 20 KPIs that we look at. And we teach them how to calculate it, how it's calculated in your DMS system, and how to improve those KPIs to make your business better. And then we track it in our, we have a software program that we use, and we track your progress during those 8-week sections. At this point, I want to definitely say, we do not sell software. We are not a software company. We don't sell software. We give it for free when you're training with us. It's strictly used as a training tool for us. When we go visit your dealership, what we do is we track. We sit down with your staff. All your managers get involved, and what we do is we document how you currently do business today, and how you want to do business tomorrow using those sticky notes. Those, you see two examples there from two dealers on those pictures. And when we find something that we poke holes in that's wasting time, wasting technicians, wasting the dealer's time, or wasting money, or costing the dealer money, or wasting the customer's time, we put those sticky notes in red, and that turns into an opportunity to change or tweak that process to make it better. After that, when we're done with a dealer visit, we put that again into our software as an action plan, and then we work remotely to try to improve those things. We don't have a manual. We don't come to your dealership and say, here's how you do business. Here's how you do after sales business. We teach all over the world, and we know every dealership is different. So we know that, from what works in one dealership may not work in another one. So we do make sure that we work with your staff together, and everybody gets involved. We get the buy-in from our managers, but we also get the managers to talk to the technicians and look at things on those processes. We get them to look at the service advisors and how they're doing business, and they respond back on how those processes are and ways to improve them. So we do work in that way.
This is the book we wrote. It's called Stay in the Bay. It talks about ways and ideas on how we keep our technicians inside that bay working on a car. When they're in that bay turning a wrench, we're making money. The second they leave that bay, we're losing money. We're losing time. There's two interesting testimonials on here that was recently done in Canadian Auto Dealer. What I think Wolfgang and I are the most proud about in these testimonials that came in from these two retailer principals, they both utilized the word buy-in. And we were very proud of that. And it's something we concentrate very hard on, is getting that buy-in. But the book will definitely give you, it's a very easy read, and it just gives you a way to start thinking differently about a technician's time. Not necessarily bricks and mortar to grow. It's growing the time we already have. Andre?
Thank you very much, Wolfgang and Andy. Very interesting perspectives and certainly a lot to think about. This concludes the formal presentation part of the session, and now we're going to use the remainder of the time to open it up to questions. We had some questions come through in advance. We've had some come through the chat. So we're going to start that way. And for folks viewing, if you have additional questions, please feed them through and we will try to get those answered as well. So before we do that, Andy and Wolfgang, before we go to the questions, let me start off by asking you this. So your last slide, and you emphasized the point around buy-in from your clients and your client staff. Can you tell us a bit more about how your process creates a lasting sense of ownership and how important that front-end buy-in is in terms of the ideation and the creation of the processes? I'm sure it helps with employee retention, giving the added role clarity and all those sorts of things, but it'd be great to get a little bit more from you in terms of buy-in and just how important that is and how big a part of that is of your process.
Yeah, it's one of the biggest things we work on and we get asked for by retailer principals is how do we keep them engaged? How do we get people engaged? So we are very focused on getting that buy-in, and we do it in a couple of ways. Wolfgang already mentioned, we don't come in there with a process book, hand you a process book and say, here's how you do business, good luck, have fun. We actually sit and build your processes with your team. We don't throw that $1 million number up and say, hey, we're going to come in here and we're going to get you an extra $1 million in sales. We hold that stuff like that till later, until we've already identified the holes and processes, so that when we say, I think we can get an extra 10% productivity, the managers believe they can get that 10% productivity. And then we show them what the value is to just get that extra 10%. We really find when we build these processes, when everyone is part of building this battle plan, I hate using it's not battle, but building this battle plan we're going forward with, they don't tend to battle the plan. They stay engaged in it because they have ownership in the way the company is about to run. And it's a very big part of us getting buy-in.
And maybe Andy, or Wolfgang, as a follow-up question to that, with your clients who've embodied these principles into their service operations, can you talk a little bit about the importance of sustainability, what the good ones are doing to not only have a halo effect around inception, but also over time, really, what are they doing to have sustainability around these principles?
Sure, I'll answer that one. The sustainability. What tends to happen is when we get into new processes and how we're getting the staff involved, and a big key factor in this is constant communication, where we have communication, we have tech meetings, we'll talk to service advisors on, and this becomes a regular routine. A lot of workshops have tech meetings, once a quarter or once every 6 months or once a year, and it's a horrible negative event. But if we have them on a regular basis, on a weekly basis, and these types of meetings, and we have a huddle with the staff to see what's coming in today and be prepared for things. So the sustainability, the communication where people feel involved, the culture changes into one of constant improvement. And people are very excited about it. They take a leadership role. We found that technicians taking a leadership role, giving more input, and they're excited to be there because it does affect their paycheck. And they find that giving them an avenue to help improve processes gives them a chance to increase their paycheck, and thus increasing the paycheck of the dealership. So,
thank you. Eric, next question's for you. So you mentioned Bank of Canada meeting today raised by 50 basis points. You had the slide up that looked at our expectations over the course of the year, and then I think it was coming down in 2024. But could you give a little bit more around kind of the interest rate expectations over the next 3 or 4 quarters?
Yeah, absolutely. So I think, in full disclosure, like if you look at where the market was kind of split today on the Bank of Canada announcement, it was, roughly a little bit more biased towards 25 basis points than 50 basis points. But I think what you want to think of what's going into the psychology for the Bank of Canada right now is, on the one hand, a lot of the kind of measures of the real economy are, certainly proving out to be a little bit more resilient, as we kind of head into the end of this year, into the start of 2023. And so that certainly is going to bias the Bank of Canada to think they have a little bit more of a challenge on excess demand, similar, to what the Federal Reserve is dealing with as well for the United States. And so that's going to one of the reasons why we likely saw them, go 50 basis points. So the, Q3 GDP numbers came in for Canada, more than double what the Bank of Canada had anticipated. So again, I think that's showing, there's a lot more resilience out there and a lot more kind of spending momentum heading into this slowdown. And so that's going to bias kind of rate hikes a little bit higher and for longer. So as you kind of pointed out, right, we don't have any rate cuts in the forecast until, the start of 2024. And I think it really does depend on how sticky inflation ends up being, right? The stickier inflation, remains well above trend here, the more likely you are to see those rates stay elevated for longer. And I think on the good, the good news side of that piece, certainly some of the shorter term measures of core inflation for the Bank of Canada have, come in promising terms. So if you look at, their two measures of kind of core inflation, they're still kind of talking about actively, which is, the median and the trim measure. Those are kind of hovering, below 4%, kind of in that 3.5% range on a 3-month basis, annualized. So again, that's certainly a positive development for, how elevated they were, kind of earlier this year. But again, I think as we kind of see more of that pricing pressure coming from the service side of the economy and core services in particular, that's the potential where those things could be stickier. So really it comes down to, if inflation, lasts longer, then rates are going to remain more elevated than we have kind of in our forecast today.
Thanks, Eric. Next question for Andy and Wolfgang that came through, and you referenced this in your materials. The question is, we all know it's hard to find experienced technicians and to keep them. From your experience, have you seen better retention of key employees because of your services and the principles embodied in your services?
yeah, it's a great question. And again, touching on getting the employees involved definitely is going to help retain them. I mean, we teach, part of our program is we teach team building and how to keep our employees happy, employee recognition. We also use something here. An interesting example would be we use a technician budgeting tool that we've created that helps technicians make their own targets and have their own type of business plans that they use. And techs love it. Technicians love this plan, and they're built this way. They want to have a target. They want to have something to achieve on a daily basis, on a weekly basis, on a monthly basis, and a yearly basis. So it really it is something that works out well. We've been to dealerships. We don't interact with the dealership staff, like the technicians. We want or the service advisors. We want the message to come from the manager that we're working with. But we've had technicians approach us and say we're so happy, we love this, and they're happier at their dealership.
Kind of a follow-up question, I guess, that came through for Andy and Wolfgang is, tell us a little bit more about the ultimate customer experience once the after-sales model is implemented. Are your customers now telling you that their end customers are becoming happier and it's building a deeper sense of relationship or trust with the ultimate end customer?
I'll take that one. Absolutely. We see CSI scores go up. We track it very closely as we're going through the implementation phase, because sometimes we make decisions in this plan that have a negative effect and we have to catch it very quickly. And that's what the software allows us to do. But in general, you'll see the CSI go up because we have reduced lead times. We have our service advisors spending more time at the car with the customer, which is building that relationship. We are so much better prepared for the customer's arrival. We've followed processes, so we are completely ready for our customer to show up at our dealership. These processes are built through the customer's eyes, but they're built by the employees. It's interesting when we have this plan and we're processing the way we do business out with the staff. We end up with these sticky notes, and then we'll have the service advisors come in and we'll have the technicians come in, and they'll look at the process map and go, no, we don't do business like that. We can't do that. So what we think we're doing sometimes isn't being done. And that's our opportunity to go back and rebuild this process. And we allow the people that say it's not done like that to help rebuild the process. All of this kind of come back into keeping that customer happy, because as we're building them, we're always looking at what does this do for the customer? What are they going to feel? What are they going to see if we change this process? So definitely we see CSI go up.
Thank you, Andy. Eric, certainly interest in interest rates and interest rates rising. So next question for you. What are the odds of the rate hiking cycle picking up more steam if the US dollar continues to strengthen against the loonie, and if the price of oil and other commodities rises over the winter? Do you think that forces the hand of the Bank of Canada, despite kind of the tone of the language at this existing meeting?
Yeah, so I would say certainly what you'd likely to see in kind of both of those events would be slightly different. So I think one of the reasons why we've seen kind of the US dollar strengthen so much and then, reverse a little bit of late, is that, yeah, I think starting with the meeting where the Bank of Canada kind of, went against market expectations and, didn't hike by, kind of the full hike and went a little bit softer than people anticipated, that kind of made people think that the Canadian kind of terminal rate would be a little bit lower than the United States. So that drove a lot of that kind of weakness between the Canadian and the US dollar. So again, I think that's one thing that matters. But I think what you're starting to see now is there's going to be a little bit more of a connection between where, inflation ultimately ends up in both countries. And so that's likely to tie, kind of where those terminal rates and how long those rates need to last for a little bit closer together. So it is something that certainly will, kind of at least cushion any potential blow that the US dollar would add kind of from an import price side. And obviously, that, kind of creates more imported inflation, as we kind of saw with, September in particular in Canada, where that was really certainly elevated. So I think that's the one piece. Now, I think on the energy piece, I don't think like again, obviously if you have a major shock, I think you can throw the playbook out the window. But I think if energy prices, continue to kind of see volatility, in particular upside volatility, kind of in the year ahead, I think what that's more likely to do than anything is keep these high rates in place for longer. And so rather than maybe the rate cut starting in 2024, you might see those kind of pushed out later into 2024, depending on how long those kind of energy price shocks. So I think those are more likely to kind of extend the duration that we're going to see high rates for, as opposed to just the terminal rate itself. But I think those are, the ongoing challenges, right? Is that central banks sort of have to get a little bit lucky, because if you want to think about it this way, maybe about 50% of the forces that are driving inflation above target today are kind of global or supply related, and the other 50% are more kind of domestic demand related. And so if you get lucky on that 50%, it means you don't have to, stamp down on kind of the domestic demand piece that you have a little bit more control over. But again, that's kind of why you could see an extension of that cycle if the global piece of that puzzle doesn't kind of, come down a little bit from what we've seen over the past year and a half.
And Eric, as a follow-up, you mentioned consumer confidence in your presentation, and there's a lot of factors that impact consumer confidence. But could you just give a little bit more in terms of your perspectives on Canadian consumer confidence and where things are generally standing going into a new calendar year?
Absolutely. So I think certainly if you look at just, kind of measures of consumer confidence, say from the conference board, yeah, they're certainly trending downwards. And normally that's kind of can be a bellwether side of, consumers thinking it's a bad time to go out and make big irreversible purchases. So certainly home prices and, new auto purchases would be at the top of the list. I think there's two reasons why you want to think of why it's going to be a little bit different kind of through this cycle. Is one that, during a recession, you typically see, kind of household balance sheets in particular weaken dramatically. But because of all the fiscal and monetary policy support we saw over the pandemic, that was one reason why we actually saw the reverse of that effect, right? So household balance sheets not only didn't go down during the recession, they actually strengthened so much. So I think a lot of that momentum, in addition to, the pent up savings we're seeing, are the two factors that are kind of combating that, downward movement in consumer confidence. So it's a little bit of, consumers certainly say that it's, a bad time to go out and buy vehicles. It's a bad time, buy a home. But certainly over the last, little while, they were doing exactly those two things. And I think when you look at where the balance between demand and supply is in the new vehicle market, right, we haven't yet seen any real movement on incentives. So if we think of, the U.S. market in particular, normally we're used to seeing, big Black Friday, Thanksgiving sales in December. Similarly, we typically see really big sales. It's going to be one of the challenges for the U.S. market, just from a seasonally adjusted point of view. Sales might look really weak in December, just for the reason that normally we expect, really big sales to kind of walk out the door in a typical year, especially on the light truck side of the market. But the reality is we don't have those incentives kind of powering the market that we normally would see kind of this time of year as well. So I think that piece of the story is really why you're a little bit more likely to see kind of the market improve relative to kind of what we saw in 2022, despite what some of those confidence measures might tell you is likely to happen in the future.
Thanks, Eric. So a reminder to folks on the line, I think we have one more question, and if there's other questions that folks have, please get them into the chat and we can get them answered as well. But the additional question is for Wolfgang and Andy. It's around the theme of kind of sustainability of the principles again, and all the great things that you talked about today. When you work with your clients over time and you go back, 12 months later, 18 months later, 24 months later, and assess the performance relative to the initial inception of the principles, how would you say generally your client base is doing with the sustainability factor?
Well, a couple of ways we could answer that question. We have a lot of dealerships that don't leave us. They like to work with us on a weekly basis and have us hold accountability, because we seem to be, very good at maintaining that accountability with the dealer. But productivity definitely increases. Efficiency definitely increases. We're seeing dealership financial statements. It's one of the things we do with the managers is we teach the financial statement to each manager in their department. That gets them engaged in what's taking place. They're looking at gross profit, they're looking at their expenses, and we're seeing dealerships become more profitable because their processes are better. We've only touched on a couple of the processes. There's so many. But again, Wolfgang, you can add to this, but the program is definitely sustainable. it all stems with the fact that we're not telling you what your processes are going to be. Your employees are building your processes. And if they have, accountability and ownership of building the processes, it helps sustain it. It's much easier to have them help you build it than just tell them what they're going to do. It's not going to be sustainable. You need the buy-in.
Thank you very much. Sorry, Wolfgang, did you want to add a few comments?
No, the only thing I wanted to add is it's interesting, just to piggyback on what Andy said, that dealerships tend to keep working with us as we move forward. And for we have some dealers that have been with us for years, but they like that one-on-one hourly session that we have with them once a week, and it becomes a coaching session because we start thinking about helping them with struggles that they're having currently doing something, or working with employees, or certain process that we're trying to get better, and it is something that they really enjoy, and they enjoy that weekly session with us, and we enjoy it just as much working with them. So.
All right, thank you very much. Sorry, well, there is one final question, Eric. This one's for you, as it's related to the evolution of the electric vehicle market. Do we have the hydro infrastructure, Eric, in your opinion, to meet the future demand? And if so, what provinces seem to have this right so far? What about the cost to build this out? Is this a public-private model? How should we be thinking about these things?
So I think it's the easy answer is both yes and no. And I'm sure if Harry Truman were still with us, he'd tell me that he would want me to have at least one fewer hand than I do have. But I think the challenge here is the following, just from like a generation capacity point of view, to pick on one province in particular. So let's pick on Ontario. Peak kind of electricity hourly demand normally runs in the neighborhood of around 24,000 megawatts. So that's all normally around the kind of end of the workday, around 5 p.m. most days. If you compare that to what generation capacity is in total, Ontario's running sort of in the mid 30,000 megawatts, so 3,400, 3,500, and that's certainly going to go up at least until Pickering and Darlington kind of go offline a little bit, depending on what they decide to do there. So I think that the challenges from an overall generation point of view in a lot of provinces, and Ontario is kind of a good example there, is generation isn't the challenge, but where those electric vehicles are being kind of sold and where they're kind of ending up isn't random, right? So if we're thinking, in Toronto, we're much more likely to have a lot of electric vehicles in, neighborhoods like Rosedale, or in New Brunswick, and neighborhoods like Rossay. And so the challenge really is at a local infrastructure level. Like when you go and plug in your car at the end of the day, the actual transmission lines that are in your local neighborhood aren't potentially equipped to deal with everyone coming home at 5 p.m. and charging their vehicle at the same time. So I think looking forward, part of that can be a demand side story. So when we think of the way electricity markets work today, right? I plug something in, it sends demand to kind of the system, and electricity comes back. But maybe for electric vehicles, what we could do instead is a whole bunch of people plug them in, but you have software in the background that's sort of going to route them to charge at different points of the day, kind of in sequence. So it kind of manages the load on the demand side itself. So I think that's one piece of it. But obviously the other piece is, we require a lot more kind of local infrastructure, and certainly transmission, I think than we're used to building over the near term. And it's easy to think that we have kind of one giant electricity market, but really we have 13 very different ones. And in particular, across the provinces, you have 3 provinces today, that just rely a little bit more on kind of fossil fuels than other provinces, mostly by like historical accident, right? We have a lot of provinces in Canada that are lucky from a point of view of being able to have a lot of hydroelectricity. It's one of the reasons why Canada is kind of at the leading edge of having about 80% of our electricity generation capacity today being non-emitting. And so the challenge will be, I think, we need to invest in a lot of infrastructure to make that happen. And we've really struggled to do that in a meaningful way. I think there was a great article in the Globe and Mail that came out that was talking a little bit about it took about 4-ish years to build the Canadian Pacific Railway. Mind you, there's certainly a lot of human and other social costs that went along with that. But I think it speaks to the question of we've gotten a lot worse at building linear infrastructure than we used to be, and that's going to be something we're going to have to get a lot better to do. And so I think to Andre's point, right, it speaks to the idea that we're going to have to be a lot better of finding kind of linkages between public and private sector buildouts, and we're seeing some instances of those. The Inflation Reduction Act in the United States had some really interesting incentives on kind of building building out, charging capacity in a more, meaningful public-private partnership. There, are also details of that in the emissions reduction plan at the federal level in Canada. But I think, in terms of details, we're, still waiting to see kind of the nuts and bolts of those. But I think that speaks to, the kind of things we need to see if we're going to make this a reality. Because, if you look at where most pathways of kind of the transition of where our energy system has to go today, about the only sector that's hitting the investment needs to get there right now is, kind of in the, oil and gas space, whether we're thinking about other kind of renewables. So like solar is a little bit close, but everything else is just, being well underinvested in today. And so I think the bottom line is, it's, you invest in energy, you don't invest in specific kinds of energy. And that's the, problem that we have to solve when it comes to the EV piece. But I think the immediate challenge is not on the generation side. So, if you're going out and buying a vehicle today, there's going to be electricity for you to charge it. But yeah, I think those are issues that certainly lay on the near term of the horizon for us to kind of solve. And I think we need to get a lot better at dealing with them than we have been.
All right. Well, on that note, Eric, thank you very much. Big thanks to Eric, Wolfgang, and Andy for your perspectives and taking the time with us today. Certainly a lively conversation and many interesting things to think about. So many thanks to all of you. And also a big thanks to everyone who joined us today for taking time out of your busy day to spend time with us. Please reach out to us if you have any questions or you would like to continue this conversation further of other topics. Please feel free to reach out. Lastly, your feedback really matters to us. So as I mentioned in the beginning, you'll see a link on your screen to a short anonymous survey. Please fill it out to let us know what topics you'd like us to cover in future events. We very much appreciate your input. You will also receive an email following this event with a replay link as well as the survey if you don't have time to do it right now. So huge thanks to everyone for participating today. Thank you for joining and have a great rest of your day.